Hi everyone, my name is Megan. I'm here from the Economics Department at University of Florida. So I think I'm probably outnumbered by non-economists here. Does anyone here study economics? Brilliant. So most of you won't know if I'm right or not, which is great. So economics is really all about incentives. And hopefully that will become clear as I talk a bit more about how social standards act as an incentive to stock market participants, and particularly during the financial crisis. So economics is about incentives, that's one important point. The second is that an equity, a stock and a share are all the same thing. Now I might be telling you something that's really obvious, but I didn't actually know that until my second year at university, and I studied economics, so thought it was a good idea to put it in there anyway. The price of equities, according to traditional finance theories such as modern portfolio theory or MPT, generally depends on factors such as risk and return. So if you have a stock that has high return and low level of risk, there's likely to be more demand for it, and it's going to have a higher price. So that's rational financial theory behind demand for stocks, and as such investment in stocks. But actually not all shares are created equal. We have glamour stocks, which are shares in companies such as Apple, Facebook, Google, YouTube, these kind of big name companies that, whose shares are well thought of and widely held by investors. And then on the other side, there are sin stocks, which are focused on my research. Now these are shares in companies whose retail or production activities are involved in promoting what is typically viewed as sin-seeking behaviour. So tobacco companies, alcohol, gambling, that sort of firm. And so as such, investment in these companies might be looked upon badly as sort of being socially responsible to invest in these companies, particularly for investors such as universities or pension funds who are upheld to certain social standards. So behind my research into sin stocks, a couple of theories. First being Becker's model of discrimination. Now Becker was the first person within economics to model discrimination by looking at how employers can have preferences over employees due to non-financial characteristics. So you would expect that an employer rationally in economics would prefer one employee over another due to their performance, their productivity, and as such how much profit they can make out of them. But in Becker's model, we consider other factors such as race or gender, and then discrimination arises because of that in an economic sense. So in terms of the stock market, what I'm looking at is discrimination against stocks, how you might pick a sin stock because you might not pick a sin stock because it is a sin stock even if it gives a high return, and as such can be productive in terms of stock. You might shun it in favour of a more socially responsible stock. Akerlof also looked at this in considering that social customs can persist even if they result in financial loss. If not observing the custom results in significant reputational loss. And so, as such, observing social customs such as shunning sin stocks can be seen as rational. Elster then went on to look at how there's a persistent divergence between social norms adhering to social customs and rational economic theory, that the two are completely divergent really. In terms of economic rationality, you wouldn't adhere to social customs. Now these are all the theoretical backgrounds what I looked at, but my paper was empirical rather than theoretical. So in terms of empirics, I looked at Verbosima and Oliphant, who found that actually sin stocks do have high returns, looking at factors such as market capitalisation and price and volatility of stocks, whether they're included in certain indices. And if you fix all these, sin stocks actually have higher returns than all other stocks. And now Hong and Kakpersik, I think I pronounced that right, found that investment in sin stocks is actually relatively low, which is the opposite to what we'd expect really. You'd expect if you have a high returning stock, investment in that would be high. So this seems to suggest that discrimination does play a factor, does play a part in investment in sin stocks. So there were two things that I wanted to look at. The first being to either confirm or otherwise previous research that investment in sin stocks is actually lower than investment in comparable stocks, even when you control for factors like returns, financial factors, that you would typically expect to affect investment in stocks. So if you have two identical stocks and they're from companies of the same size, they're the same price, the same sort of volatility, including on the same indices, and one is a sin stock and one is not, investment in the sin stock on average will be lower. Now the second point in adding to the research that I wanted to consider was how this was changed across the financial crisis. There were two sort of hypotheses in this. The first being that financial institutions and therefore investors will be under increased scrutiny over the crisis period, so more likely to adhere to social norms because there's more people watching them and there's more sort of bad feeling towards financial institutions, so they're going to be more keen to adhere to these social norms and not invest in stocks. And the other side of the argument is that within a recession, profit has gone down for a lot of companies, and so profit motive is heightened, and the investors will be more keen to make financial gain rather than adhering to social norms. So to do this, I performed some econometric regression analysis, which I won't go into too much detail because I don't want to overexcite you. So that basically is looking at how X affects Y. Y in this case being institutional investment in a given stock, so institutional ownership of the shares, how many out of the total shares in issue are owned by institutions such as universities, investment companies, insurance companies, pension funds. And so I wanted to look at how this is affected by whether a stock is a sin stock or not, and also how this has changed across the crisis period. And then within this, I controlled for variables, as I mentioned before, such as price, volatility, and market capitalisation. My data was from Reuters, and I looked at the US in particular, and looked at over 4,500 stocks across 13 years. And these were my results. Three main points. The red line here is investment, institutional ownership of sin stocks, green of non-sin stocks, so that's all other stocks. So you can see that institutional ownership is significantly lower for sin stocks, and investment in all stocks is lower since the crisis. And that was a common feature that was observed across the crisis period, that the stock market actually shrank, which began as early as 2006. And the most interesting point, I think, is that the decline in ownership of sin stocks is actually less than the decline in ownership of non-sin stocks. So even though there is still discrimination against sin stocks, and it's still seen as negative to be investing in these companies, there's actually a smaller gap between the two. So across the recession, profit motive was heightened, profits harder to come by in a recession, and therefore people seem to be more incentivized to invest in any stocks they could that would provide high returns, such as sin stocks. So in conclusion, economics, as I said, all about incentives, and as profits reduced in the recession, people were more incentivized to find ways of making profit through investing in these stocks. Going back to the original point, equity, stock and share, all the same thing. And so discrimination does exist in sin stocks, but this has been reduced across the recession as profit went down for all firms. So thank you very much for listening, and happy to take any questions.